Hello everyone. Today we are going to analyze the American stock market and its main indicator, the Dow Jones Index. It largely determines the strength or weakness of the American economy because it consists of the 30 largest companies on the US stock market. Accordingly, if the American economy is doing well, then these companies are also doing well. And if for some reason these companies are not doing well, then that most likely means that and the American economy is also doing badly, which as a result affects the global economy as well. Before we start analyzing the chart, here's a brief historical background. In 1892, Charles Dow and Edward Jones founded the Dow Jones Company, and in 1896, the Dow Jones Index was created. At that particular time, it originally included precisely 12 significant industrial companies, and the index's initial foundational value was approximately around 41 points, more or less. Right now, as you can see, the index is trading at 46,620 points. The largest historical drop of the index occurred in 1987 when it lost about 22% in a single day. And the largest single day gain was about 15% in 1933, when the index was recovering after a very steep decline that began in 1929 and was known as the Great Depression. Let's move directly to the chart, but before that, I want to mention one more thing. Today is Friday, the end of the work week. And yesterday and today, many stocks in the indices have reached new all-time highs. Many people attribute this to Donald Trump's phone call with the leader of China. But for me, to be honest, this is neither a particularly good nor a particularly bad indicator. In fact, it's not an indicator at all because I tend to do my analysis exclusively based on the chart. The chart knows nothing about Trump's phone call, not about any other things, so let's do the same. If you pay attention, there are very few candles here. This is a monthly chart of the E-mini Dow Jones futures, which are traded on the Chicago Mercantile Exchange and which you can trade on the Quant Yuga platform where we are right now. But every futures contract has a start date and an end date called the expiration date. That's why the chart is so short. We, however, will look at a long-term historical chart, and for that we'll use a fund called the SPDR Dow Jones Industrial Average, which is based on the S&P index on the Dow Jones Index, and differs from it by about a factor of 100. That is, it doesn't repeat it absolutely symmetrically with a 1 to 100 ratio, but it's very close. For us, that's not crucial because we'll be looking at large time frames. And so if we multiply the value 462, if we multiply 462.91 by 100, we get 46,291 points. We saw that the Dow Jones is currently trading at 46,600 points, not a big difference. Now let's pay attention to the following point. I want to emphasize these are monthly candles. Look, here we had some highs and here there was some RSI high. Here we have new all-time highs. The RSI is significantly lower. When this happens, when the price or index keeps making higher and higher highs but the RSI doesn't keep up, it indicates that the fuel for this rally is very likely running out. This makes you think about the risks of a potential reversal or decline, and when it happens it will be sharp and fast and no one will warn you about it in advance. Therefore, buying here and now is not the right move, but there is also no reason to open a short position. When could such a reason appear from the perspective of monthly candles? For example, if we look at this section, here is a green candle. It was making a new all-time high. This red one didn't engulf it, but the next one from February 2022 did. And in fact, right here is where the trend broke. And as you can see, the trend continued downward. So when we see a similar pattern where a green candle is engulfed by one or more red candles, that's when we can talk or think about shorting. For now, no shorts. But buying at all-time highs, in my opinion, is also completely wrong. And from a technical analysis perspective as well. Now let's look at the weekly candles. What do we have here? So on the weekly candles, we can see that the RSI is pointing upwards, all the candles are green, and there is absolutely no reason to open a short. This is a long position that should be held if you entered long at lower levels, but entering a long now is also not the right move. Let's look at the daily candles. On the daily time frame, it's basically the same situation, exactly the same. But here, if you try to draw some lines, look, along the lows there's one line and along the highs, well, it looks like this. This is a narrowing wedge. Statistically, such wedges are usually broken to the downside. Notice that the price highs are rising, or rather, the index values are rising. It's more accurate to say index values, since this is not a price, it's an index. But the RSI high is, at best, staying flat. This is a divergence. So the divergence can look like this, or it can look like this. But in both cases, the lines are diverging. One is going up and the other is moving horizontally. And this is exactly the case we have here. And this is a potential divergence. But we don't have any engulfing patterns here, which means it's too early to open a short position. But there are prerequisites, hints at this short, hints that the movement is running out of steam. They exist despite the phone conversation between Trump and Xi Jinping. We've sorted this out. Now let's clear everything and take a look at the 4-hour candles. We can wrap up our review here. The situation is similar on the 4-hour candles. There are no engulfing patterns. Here's a big green candle. No one has engulfed it. We only corrected somewhere to its middle. Here's a big green candle. I think we didn't engulf this one either. We just moved towards its base. So basically it's also a long here which is continuing. But this is a very risky long. If you have a long position, it makes sense to partially lock in profits. Because when the reversal happens, it could occur with a gap. On Friday, we might close at one level, and on Monday, open at a much lower one. I'm just saying... I'm not saying this will happen this coming Monday specifically. But that's the first option. Partially lock in profits on your long position, so you won't regret it later, and you'll have a good profit. Otherwise, you might end up losing it. And the second option is simply to protect your long position with a stop loss. A relatively tight one, so that if the market turns around, it closes with some profit and minimal losses. That's the story. With that, I suggest we wrap up the review. Let me summarize once more. If you have a long position, it makes sense to keep holding it, because the market is looking upward right now. You shouldn't open any short positions. There's nothing on the chart that suggests opening a short position. Opening a long position, even though the market is still looking upward right now, is, in my opinion, not the right move. If you enjoy these kinds of reviews, subscribe, leave comments, and hit the notification bell. See you in future analytical reviews on this channel.